are coming along well. I think we are steadily easing into the year, and when I think of it, maybe steadily is even a wrong word to use because it feels like the year is moving by at such a fast pace. I mean, I cannot believe that we are now in May and test two is around the corner. Right after test two, it's test three, and before you know it, the final exams. So I really do hope that you are not falling behind with your studies, that you have established a routine that works for you, and you know where to find your study material. Before I carry on any further, let me introduce myself. For those of you who don't know me, my name is Airam Komazi, and I am one of your text lecturers. And this morning, I will be taking you through one of the topic 3 exam technique sessions. So the session is specifically for text 4862 students. However, text 4861 students have also been invited because I believe that they will also benefit from the session. There are some topics or sections that are specifically not in the syllabus for text 4861, like the transfer pricing, which is part B of the question that we will look at today. When we get to such topics, I will make an announcement and the text 4861 students will excuse themselves. Okay, so let's get started. So on the slide here, this is just a reminder of the fact that you are now in the text study week, right? And we are on topic 3. So your study week has started, or it started on Thursday, the 7th of May, and it will run until the 13th of May, which is next week, Wednesday. So this means that during this period, your main focus should be on text. And I know that you all have different schedules and you have different study plans that work for you, but as per the CTA program, this is where your focus should be, meaning that by now, you should all be ready to conquer your financial accounting, auditing, and management accounting. In terms of what you need, these are the resources that you need that you will find on my UNISA. So at this point, I'm assuming that everyone has downloaded the 4 LUs that you find in topic 3. And what you will find inside the LU, similar to what you've seen in topic 1 and topic 2, is that you will find the bean counter scenarios. And I know that by now you have all been following the bean counter family. So similarly in topic 3, in each of the 4 learning units, you will find the bean counters. You can read them in the study guide or you can watch the video that we have uploaded for you on my UNISA. So please attempt to answer the questions in the bean counters and post your response in the discussion forum for each learning unit. This is also a way for you guys to engage with your fellow students. So do not be shy to check a few responses. And if you see that your fellow students are off ramping a little bit, you are more than welcome to respond to them. Other study material that we have in topic 3 is that we have the slides, we have the additional questions for you guys to attempt, and we also have the pre-recorded learning videos, right? Now, a lot of students are not aware of these. So these are short videos on some of the specific topics that we have pre-recorded where we take you through a particular section. For instance, in topic 3, you will find a short video on prepaid expenses. And there's actually quite a lot of these videos in topic 3. As you have seen, topic 3 is quite a big topic that has a lot of content. So I would advise that you listen to these videos, perhaps when you are driving from work or you're driving to work or you're washing dishes. As I said, that these are short videos that explain certain concepts. Where do you find the videos? We save them under additional resources on a PDF document that we have named Video Lecturer Links for 2026. Please note that in order for you to be able to watch these videos, you need to use your My UNISA My Life account. Okay. Then in terms of the support that's available, we have contact sessions. These are your classes. We will have 3 of them for topic 3. The first one being today, and the other 2 are going to be held next week on Tuesday and Wednesday. This will be held at our usual 6 to 8 p.m. And maybe at this point, I should just mention that it's not really the norm that we have our classes on Saturdays. Today was just an exception. And let me say it was an experiment at most. So most of our classes, they happen on weekdays at 6 p.m. Okay. Then we also have the online consultations. You can also send us emails if you have any technical queries on the text mailboxes, because there's always a lecturer that is on duty every day to answer your emails. Then you know test 2 is going to be written on the 19th of May. You already have the test schedule, and by now you should all be familiar with the venue-based writing provisions, so I will not get into that one. In terms of the scope, this is one of the questions that we actually get a lot from students. In terms of what's going to be tested in test 2. So you need to remember, test 2 covers the topics that you find in topic 3, right? This means it's your LU7 to LU10, together with any case laws that are relevant to this topic from the case law guide. So for instance, in LU7, you are going to deal with deductions, right? Your general deduction formula. So it means that case laws relating to the general deduction formula should also be studied. However, it's worth mentioning that it doesn't mean that the test will only cover the topics that you find in topic 3. All the topics that you have covered in your previous topics, so your topic 1 and your topic 2, please note that they can and they may be incorporated in test 2. So remember that we are studying progressively, we are not studying in silos. So this means that everything that you have learned since the beginning of the year, and even from undergrad, is actually a build up to the next test and ultimately to the final exam. So it's possible that when you see test 2, you can expect to see a VET question in test 2. We can integrate and we intentionally set up our topics and our study program in this manner so that when you get to certain topics, you already have the knowledge of certain sections that can easily integrate. Okay, so please do not forget about what you learned when you were preparing for test 1. And speaking of test 1, I think it's important that we take a minute just to reflect on how you guys performed for test 1, right? So that you go back and you learn on where you made mistakes so that you don't repeat the same mistakes going forward. So on this particular slide here, I have the test 1 results for text for rate 6-2. And I'm actually very happy to announce that we have a pass rate of 56%, right? So well done to you guys and congratulations on your results. The reason that I'm happy with this pass rate, if we look at the next slide, is you can see that year on, we are seeing an increase or an improvement with your test 1 results. Test 1, it's one of those that's quite difficult because we are testing 2 topics. We have 6 learning units. You have VET, you have CGT, and those are big topics on their own. So it's a lot of content that you need to study for the first test, right? So on this slide here, I just have a comparison of your results from 2026 to 2024. And as I've mentioned, as you can see, we have an upward trend where in 2024, the pass rate was about 10%. If we look at 2025, the pass rate was sitting at 40%. And this year, we see another increase of that 56%. So I'm very happy with the results. I'm very happy with this line. And the opposite as well, inversely, since we are seeing an increase here, it means that we will see a decrease on the number of students that did not pass, right? When we look at the average mark has been a bit steady, although it did decrease from the previous year. So the average mark for this year was sitting at about 39%. Okay, so there's a bit of improvement that we need to do there. On the highest mark, I think the highest mark was sitting at about 88%. So congratulations to that student who obtained the highest mark, and we have the low mark of 3%. Now, if we quickly look at tx4261. So with tx4261, the pass rate there is sitting at 24%, right? Which is almost a quarter of students that passed. Although you might be sitting there and you might think that 25% is low, it's actually quite pleasing to a certain extent because even here we are seeing an improvement year on. Last year, the pass rate was at the lowest pass rate. So we are actually happy to see this upward trend, and we believe that it will even reach greater heights, right? Average mark is looking better, also increasing. So the average mark for 2026 is sitting at 37%, if I'm not mistaken, whereas last year it was about 34%. So we are seeing an increase there as well. And maybe what I should mention is that although we have 24% of students that obtain 50% and above, it's also worth noting that we have about 41% of the students that are sitting in the 30 to 49% band, which is good. I'm sure that these students, they just made a few mistakes due to bad exam technique. Therefore, that's why I was saying earlier that it's important that as soon as you have received your marked script, that you go through it with the solution and also the debrief so that you can learn on where you went wrong. Then just to wrap up this slide, on the high mark, the highest mark was also 88%, if I'm not mistaken, for tx4261 compared to last year's 76%. So congratulations to those students that obtained 88%. And I'm saying students because I think there were two of them that obtained the 88%. Okay, so moving on to the next slide. As I said, that now that you have received your results, it's very important that you go through your marked script. You take the solution, you watch the debrief recording so that you can analyze and see where you went wrong, right? And also see where you went right because we want to see more of that. So it's very important that you reflect. And I know that a lot of students, they tend to skip this part. However, let me tell you, you are actually doing yourself an injustice if you do not reflect. Many times, we find that the common mistakes that students make is because of bad exam technique. So if you skip this part of the test debrief, you are actually at risk of repeating the same mistakes that you have made in test one, right? And I've noticed that with tx4262 students, I believe that they are technically sound, right? Well, to a certain extent, but most times they end up losing marks because of wrong exam technique. So you need to spend time to go through those test debrief, go through your marked scripts so that you don't repeat the same mistakes for your upcoming tests and the exams. So I included this particular slide just to highlight in general some of the more common mistakes that we see students making in an assessment, right? I recall, I think it was on Monday, I was attending an IAC board course session, and Dr. Masiya, your COD from Financial Governance, was doing a presentation on some of the common mistakes that IAC candidates make when they write the board exams, which comes from the SAICA's feedback, okay? And I find that these mistakes are similar to what we are seeing our students doing wrong in our assessments as well. These mistakes, they can actually make a difference between a pass and a fail. So it's important that you learn from them as you do your questions, okay? There's 4 behaviors that SAICA picked up as the common mistakes that students make, but I only want to speak on two of them, right? Which is not answering the required and the issue of time management. When it comes to the required is very, very crucial to your success. And I'm saying it's low because I'm actually quoting the school director on this point. When you do not understand what is required of you, then you will most likely not do well in that question, right? You need to do what you are being asked to do. Read the required with understanding. Look out for the verbs. If we are asking you to calculate something or to explain or discuss something, those are two different things, right? And oftentimes we see tx4261 students, and I'm not picking up on tx4261, but whenever we ask for a discussion, most of the students will give us calculations. So remember that when we say discuss, we mean that you need to write something in words. If you give us any calculations, do you think that you will get any marks? Probably 1 or 2 marks. Because remember, Mr. Stephen Lever said when you discuss, it's good that you include supporting calculations where applicable. Do you think that you will get any communication mark? Absolutely not, because you are not addressing what we asked of you, and therefore we cannot award any communication mark. So you need to ensure that you do what you are asked. Mashudu, I don't know if she's in class, so Miss Niswiswi, she has a way of reading the required where she takes it step by step. She takes each wording step by step to ensure that she doesn't miss anything. Another thing that I need to make you aware of, I like to write when I'm presenting, so I'm just going to bring up my pen. As you are reading the required, you need to pay careful attention to the verbs that are there. You need to pay careful attention to words such as if they say ignore something, if they say do not do something. Because if you miss these verbs, or if you miss these words, you are at a risk of addressing something that we said you must ignore. And the consequences of that is that you would have wasted time on that particular question, which leads me to the second point of time management. But before I get to the time management, I also wanted to speak about the text terminology that some students, they tend to overlook, or sometimes they don't understand. So some students, we find that they confuse text terminology, and as a result, they end up answering what was not required. So remember that there's a difference when we mention or refer to text implications versus income text or normal text. And this particular picture, I actually took it from the SAICA exams guidance. So we are saying that when we speak about normal text, or when we speak about income tax, this is actually one and the same thing. If you go to your legislation and you go to Section 1 of the Income Tax Act, you will see that normal tax is defined to mean income tax. So we actually use these terms interchangeably. And what do we mean when we say normal tax or income tax? This is basically just your income tax as you know it. And most importantly, remember that CGT, although you find it in the 8th schedule, it does form part of income tax in terms of Section 26A of the Income Tax Act. Therefore, this means that if there are any CGT implications in the question, and we are asking you to give us the income tax or the normal tax, that you need to remember to include CGT as well, because it does form part of income tax and or normal tax. Okay. And this is applicable on whether you are dealing with an individual or a company. Normal tax and income tax mean the same thing. The other thing that we have is what we refer to as just tax consequences or tax implications. So tax is broad. As you know, there are different types of tax, right? So if we say, give us the tax implications of a transaction, we are not being specific on which tax. So what does it mean? It means that you need to give us all the different types of tax implications that are applicable to that scenario. These may include your income tax, dividends tax, VAT, donations, etc. You will be guided by what's in the scenario and also by the number of marks. So if we say, give us all the tax implications, but ignore VAT or ignore a certain type of tax, then you do as you are required. Point 2 that I wanted to come back to is on time management. So time management, it's always a concern. We often see students not finishing their paper, and that was the case in test 1 with some of the students. The issue with time comes in when you go over time on just one question. And by the time that you know it, writing time is over, you didn't attempt other parts of the paper. So we usually tell students that we use the 1 mark is equals to 1.5 minutes. So since your tests are 40 marks, then it means that you have an hour or you have 60 minutes of writing time. So as you are reading the required, I like to advise students to take a minute and calculate how much time you will need in each part of the required and write it down for yourself next to the required. So if the required is 10 marks, then you know that, okay, for 10 marks, if I multiply it by the 1.5, I'm going to get 15 minutes in order to answer that part of the required. And you ensure that you stick to that 15 minutes. You do not go over it, because if you do, you risk not finishing the whole paper, and you might find that you spent all your time on one part of the paper, whereas if you had attempted all the parts of the paper, you would have probably passed. So please practice as you are doing questions. Do it under exam questions. Time yourself. Do not go over the time for each question, even if you think you know the answer to that particular required. It doesn't matter. You need to move on if your time has elapsed. Okay, so on this particular slide that I have here, as I said, today is on exam technique. But before we get into that, I have this slide which provides a breakdown of which topics or which sections are in each learning unit, right? And as you can see, when we get to LU10, we have section 8F and section 31 that we said is for text 4862 students. But there's something that I want to bring to your attention, right? That from this year onwards, we have actually narrowed the scope even further for text 4861 students. What I mean is that there are some topics or there are some sections that we have excluded from the text 4861 syllabus. So it's important that you pay attention to your study guide, look at the table of reference, and see which sections are examinable and which ones are not examinable. If I think from the top of my head, I think in LU7, I think all these topics are in scope for both level 1 and level 2. Then for LU8, in LU8, I think we took out section 19 and paragraph 12A. So that section that refers to your compromise of debt or your debt benefit is no longer in scope for text 4861. LU9, everything is in scope for both levels. LU10, as I've mentioned, 8F and 31 are excluded for level 1. And I think there's also one section that we took out. Yes, section 24O. So section 24O is another section that we excluded from the syllabus for text 4861. So please be on the lookout on that table of reference so that you don't end up studying sections that are not part of your syllabus. So this is for text 4861 only. Then for your text strategy and risk management, this one you will find in chapter 34 of your Silk. And here I just wanted to highlight that for text 4861 students, that you only need to read the chapter. But if you are a CTA2 student, then you need to study it because it may be examinable. Okay, just looking for my cursor to go to the next slide. Right. So, as you have seen, topic 3 is all about the tax on companies. And on the slide, I just wanted to highlight that for your tax studies this year, that there are 4 types of companies that you will come across. And I actually took this diagram from your topic 5 study guide that you will learn about later on in the year. So it's important that you know what type of company you are dealing with, since the tax rates might differ and some tax treatment might differ as well. So for your studies this year, we are going to deal with a normal South African company. We have your small business corporations that you find in section 12 cap E of your Income Tax Act. We also have personal service providers and a little bit of foreign companies. When we come to topic 3, the most that you will see is your South African companies and a little bit of small business corporations. So if we look at the first one, the South African company, so this is any company as you know it. It can be a public company, or it can be listed, or it can be private, which is incorporated in South Africa. So in most of your questions in topic 3, you will most likely come across a South African company. As I said, it can be listed or it can be private. The tax principles that you need to remember for South African companies is actually what topic 3 mostly covers, from your deductions to your capital allowances. Just a reminder that for companies, the tax rate, the corporate tax rate is 27%. It's not 28%. So if it happens that you have the old tax legislation, please just remember that the tax rate has changed since 2023. So if it happens that you get a question that asks for a South African company's final tax liability, we expect to see your taxable income multiplied by 27% to get the final tax payable. We don't want to see 28%. We don't want to see 29%. Most times we see some funny tax rates that students use in the questions. It's only 27% and you get your 1 mark. Dividends tax, if there's any dividends that is being paid, they are subject to the dividends withholding tax of 20%, but this one again you will learn in topic 5. The second type is a small business corporation. So your small business corporations, you find them in section 12E, and there are specific requirements that needs to be met in order for an entity to be classified as a small business corporation, or an SBC in short. And again, these requirements you will learn about in topic 5. But for the purposes of topic 3, because we can still test you on SBCs, what you need to be aware of is that small business corporations, they have their own capital allowance rates, and they also have their own tax tables when you need to calculate the final tax liability. So this means that for an SBC, you are not going to apply 27%. You are going to use the SBC sliding scale or the tax table for small business corporations, which you will find as an annexure in your question. So in topic 3, if ever we want to test you on small business corporations, we are going to be clear, we are going to be specific in a question on whether the company that you're looking at is a small business corporation or not. But you will see later on when you get to topic 5, you will, at times, you will need to make an assessment yourself on whether the company is an SBC or not. The principles, as I have mentioned, they have their own capital allowance rates and you apply the tax table for SBCs. The other type that we have is a personal service provider, which is short for PSP. So this one, you will find the definition in paragraph, I think it's paragraph 1 of the 4th schedule. But again, this you will also learn about in topic 5. What I wanted to highlight is that as per the definition of a PSP, a personal service provider can either be a company or a trust. If that personal service provider is a company, then you need to remember to apply the tax rate of 27%. The last type is a foreign company. So with foreign companies, here we are referring to a foreign company that had carried on a trade in South Africa, either via a branch or an agency. So if ever there's such a company, you apply the rate of 27%. And remember that since it's a foreign company, it will get taxed on the receipts and accruals from a South African source only, unless a DTA is applicable, of course. So what you learned in topic 2. So basically, these are the different classifications of companies that you will come across in your studies this year. And it's important that you differentiate because the tax principles for these might be different in some instances. Okay, now on this slide, I have the framework for the calculation of a company's taxable income, right? This is one of those that you will see quite often in your slides, or you have seen quite repetitive in your topic 3 slides. The reason that we are repeating this is that the order of the calculation for the company's taxable income is it's important, and you need to pay careful attention to the order because it has actually changed a bit from the previous years as a result of the 18A legislative amendment. So how do you get to taxable income for a company, right? So you know that it is income. Income is defined to mean gross income less your exempt income. So this is what you learned in topic 2. You reduce that income by your deductions and allowances. And this is now where topic 3 comes in. Your deductions is what you see in LU7 and allowances is in LU8. Thereafter, this is now where the order has changed from last year and you need to pay careful attention. Previously, if you remember, after you have your income and you reduce it by your deductions and allowances, right after that, you would bring in your balance of assessed loss in terms of section 20. But if you look now in the new order, this is now the very, very last deduction in the framework. So after your deductions and allowances, what you do in terms of the new order is that you are going to bring in, or you are going to add the CGT. So this is again what you learned in topic 2. So CGT, as I mentioned at the beginning, CGT forms part of your income tax. You include it in taxable income in terms of section 26A of the Income Tax Act. So once you are done with your CGT calculation, if you end up with a net capital gain, then you need to include it in your taxable income. Okay, and at this point, I feel like I've been talking a lot, and I'm going to ask Saj to bring up question 1 of the poll. So Saj, if you can bring up question 1 so that the students can vote. So I'll be doing a poll during the session. I only have a few questions, just 2 or 3 questions because of time, but I want to get an idea of where everyone is at with their knowledge. So Saj will be assisting me with the poll in the background. So Saj, you will let me know if the poll is up. Okay, I think the poll is up. So
Yes, the poll is
basically,
up.
thank you so much, Saj. This is a simple and a straightforward question. And what I want to know is what is the CGT inclusion rate for a company? So which CGT rate would you use to include the net capital gain of a company in its taxable income? And I'll give it a second just to see how the students are voting. I see Elian Doe's question in the chat, and he's asking if the tax sliding scale for an SBC is the same as the turnover tax. No, it's not the same. Those are two different, they have their own different scales. So you will see in the legislation, SBCs have their own scale, turnover tax also has its own scale. But remember that we are going to provide you with the sliding scale in the questions in an annexure. Okay, I'm looking at the vote results and yeah, I'm a little bit worried. So remember the question said, what's the CGT rate for a company that you will use to include in the taxable income? Okay, so 89% of the students are saying it's 80%, and then we have about 10% voting for 40%.
There are some saying 33.3%.
Yo, I get worried when I see such. So those two students that voted for 33.3%, I think they might have um the old legislation. So remember, this is what you guys learned in topic 2, right? The rate that you include, the CGT rate that you would use to include in taxable income for a company is 80%. You include 80%. If you are dealing with an individual, that's when you use the rate of 40%. It's never 33.3%. I think 33.3% is actually an all CGT rate, and it's never 0% as well. So those students that said 33.3%, please note that the CGT rate changed a while back. Those students that said 40%, 40%, remember, is specific to individuals. But if you are dealing with a company, then the inclusion rate is 80%. If it happens that you end up with an assessed capital loss, then you do not include anything. The principle is that you carry that assessed capital loss forward to the next year of assessment. So that's the CGT inclusion. It's the third last item on the calculation.
Ida, can I interrupt? Sorry.
Yes,
My
please.
biggest concern is that there's about 95 students or so who didn't vote. So I'm not too worried about somebody who says 33% because they definitely went and checked somewhere or applied their mind. But we have a very big group of people who are sitting nowhere on this fence.
Are they actually listening? Or did they just put on the...
That
Yeah,
is my
that's a
concern.
concern. I hope that everyone is awake. Sure, I see what you mean. So as Tungu mentioned, it is a big concern that we are seeing a lot of students not participating, and I'm not sure what the reason is. So I hope that those students that are quiet, they know the tax rate, and maybe it's because I'm asking a silly question. Nhlamulo says it's maybe they voted zero. I don't think so. So please do participate, because as I said, I just want to get an idea of where you are at with your knowledge, so that if we need to go back and if we need to go back, I think I need to stop looking at the chat. If we need to go back and reinforce some principles, then we know where to look. Okay. So coming at the tax framework calculation, as I said, the third last item is your CGT. Then we have the second last item, which is the deductions in terms of Section 18A. So this one, if you were a CTA1 student last year and you are now in CTA2, you would have seen that in our slides, this 18A deduction, it used to be the very last deduction. However, as I have mentioned, because of a recent amendment, 18A is now the second last deduction because of that amendment on assessed losses that occurred in 2023. And actually, maybe now, since I'm speaking on donations, this is a good time to have a look at some of the principles for donations. Okay, so with donations or Section 18A, you get a deduction of it from your taxable income on any qualifying donations. And what's a qualifying donation? A qualifying donation is a donation that is made to a public benefit organization and or to a PBO. And in order for you to get this deduction, there needs to be a valid Section 18A receipt that is being issued. So if you see in the question that there was a donation that was made to a PBO and there's also a Section 18A receipt that was issued, then you can get this deduction in terms of Section 18A. And remember that we will tell you in a question, we will be clear if the donation was made to a PBO or not. In terms of how much you can get as a deduction, do you take the full amount of the donation or not, right? So 18A says that the deduction is limited to 10% of the taxable income. Before this deduction, before 6 quad, and most importantly, before the setting off of a balance of assessed loss. And this is where the order of the calculation has changed. This is where the amendment comes in. It says that you need to first apply the Section 18A deduction first. This means that you need to determine the deduction, you limit it to 10% of taxable income before the assessed loss. And this is the reason that the assessed loss, your Section 20 deduction, is now being put as the last deduction. Okay, so if we look at the tax framework, if ever you get a question that has a qualifying donation, and it also has a balance of assessed loss. You first apply the deduction for the qualifying donation. So this would mean that you would have determined your income, you reduce it by your deductions and allowances, you add your CGT, then you get your subtotal. You bring in your 18A donation, but you limit it to 10% of that taxable income subtotal. Thereafter, you get your subtotal again, and you bring in your balance of assessed loss in terms of Section 20. So this is where the order has changed that we wanted to highlight for you guys. So please be cognizant of that if ever you get a question or a calculation that has a qualifying donation and a balance of assessed loss. Then the last thing on donations, just remember that if there are any donations that are in excess of 10% of taxable income, that you carry that forward to the next year of assessment. And if it happens that a taxpayer is in an assessed loss position, then you cannot get the 18A deduction. There's actually some examples that we have in the slides and also in the Silk textbook that you can look at. Now for assessed losses, remember now we are saying that assessed losses is the very last deduction in the calculation, right? Principle-wise, I just wanted to remind you that since March 2023, the deduction for the balance of assessed loss should not exceed the higher of 1 million and 80% of taxable income before taking into account this assessed loss. So this means that the balance of assessed loss that is being brought forward from the previous year is limited to the higher of 1 million or 80% of taxable income. And I have this example that I took from the Silk textbook. If we quickly apply the principle, we have a company here that has a 31 March financial year end, and they have a balance of assessed loss of 1.2 that is being brought forward from the previous year of assessment. In the current year of assessment, the company has a taxable income of 1.1 million rand. And the question says, calculate the normal tax liability. So we are at the very last deduction in your tax calculation. You have a taxable income before the set-off of a balance of assessed loss. So this taxable income would come after you have determined your donation deduction, right? Now you need to determine if you will get a deduction for this assessed loss. The principle says limit it to the higher of 1 million or 80%. What's 80% of taxable income? 80% of 1.1 million is 880,000. So the higher between the two would be the 1 million. The balance of assessed loss is 1.2. Therefore, you are going to limit it to 1 million. And that's the deduction that you will get in terms of Section 20. What do you do with the remaining balance of 200,000? That remaining balance, you carry it forward to the next year of assessment. And again, in that next year of assessment, it will be subject to the limitation rules in Section 20. Okay, so that's that on the tax framework. So remember that with the tax framework, the order is very important. The order has changed from previous years. Pay careful attention to the last three items. After your deductions and allowances, add your CGT, get your donation deduction, get your Section 20 deduction. If it happens that you get the order wrong, then unfortunately you will not get any communication mark. So this is how you get to taxable income or assessed loss of a company. Now, to get to the final tax liability, remember that you need to multiply the taxable income by the corporate tax rate of 27%. If it's an SBC, you apply the SBC tax table. The last thing that I wanted to point out is you need to check the required. If the required asks you to start with the net profit before tax, then you need to be cognizant of any accounting adjustments. What do you do with them? You reverse them in the instance that accounting and the tax treatment will be different. The example that I like to use for this one is the depreciation versus the capital allowance. So since depreciation is an item that will be part of net profit, when you calculate taxable income, you would need to reverse out that depreciation because it would have been deducted from net profit. So you reverse it out by adding it back. And then you bring in the tax capital allowance. Okay, so please remember to read your questions carefully. And I want to go back. There's a particular slide that I included that when you read a question on companies, there are some common items that you should bear in mind as you are working through a question so that you can get a clear picture of the type of question that you are looking at. The first one that I have is the resident or residency of a company. And maybe not just company, because this applies to an individual as well, or any other taxpayer. When you know whether a taxpayer is a resident for tax purposes or not, if they are a resident, it means that whatever it is that you are looking at it from a worldwide incomes perspective. And I noted here, if the question is silent, then the default is to assume that the company is resident. But I'm sure you have seen that in most instances in our questions, we do mention whether the taxpayer is a resident or not. The second item is the type of company. And here I'm referring to those 4 types that you have seen in the previous slide, so I will not get into that. The third one is the year end of a company. So here we are referring to the year of assessment of a company, and I say that you must draw a timeline. You need to write the timeline because when you know what's the year of assessment of a company, you will know which transactions will fall in that year of assessment that you're looking at. For instance, if the year of assessment is 31 December 2026, then you know that the year of assessment will start on the 1st of January 26 and it will end on 31 December 26, provided, of course, that that company was trading for the full 12 months. So you are going to focus on transactions that fall in that period. And I always tell students that they must not underestimate this. You need to write this timeline at the top of your question, at the top of required, because I'm sure that you have realized that some of the part marks that you earn in tax, they actually relate to a basic math calculation, right? What I mean is, when you think about section 11 small e, with the wear and tear allowance or section 11 small e, you need to apportion, and you need to do so by using the correct number of months or the correct number of days. Similar with the interest, you need to provide the correct number of days, okay? Number 4 is what the company does. And for this one, what I mean is you need to have an understanding of what the company does. This will assist you as you are reading to get an idea of which capital allowances you need to claim. So you might find that the company is probably leasing, or it might be a company that's involved in the generation of renewable energy. Then you would think of section 12B. Or it might be a company that has its process classified as a process of manufacture, then that would trigger your section 12C. So you need to be cognizant of things like that, that when you are reading the required, you can get an idea of the allowances that you would need to claim. The last thing I have is on the VAT. So with the VAT, for our purposes in topic 3, or income tax, you need to know whether the amounts that we have provided in the question are VAT inclusive or VAT exclusive. So that VAT that you have studied in LU3, you should not study it in isolation because it does influence income tax to a certain extent. For instance, we have Section 23 Cap C in the Income Tax Act that says that the cost or the market value of certain assets, it needs to be reduced by VAT if the taxpayer is a VAT vendor and VAT was claimed as input tax. So please be on the lookout for this and don't forget that you need to use amounts excluding VAT when you are calculating capital allowances. Other, I have a question mark there. So with other, what I can think of, since now we looked at donations and the assessed loss, as you read the question, just check if there's any qualifying donations and balance of assessed loss, because now you know that the order has changed because of the legislative amendment. So please bear in mind the order of the calculation. And at this point, I think we can look at the question. I know it's 1 hour over the class, but I think it was important that I go through some of those slides, especially as they speak on exam technique. So with the question, this question, as I have mentioned, it related to last year's text 4862 test 2. And I hope that you all have attempted the question. We did upload it for you guys as an announcement. So this question, as I said, it was last year's test 2 for CT82 students. And unfortunately, it was actually poorly answered. So I think the pass rate there was about 12%. So it's important that as you are doing it, you understand the principles. I think if I recall, the reason why the students didn't do so well in this test was because of part B, which relates to transfer pricing, which is for CT82 students only. Okay, so let's start with part A so that when we get to part B, we can excuse the text for 861 students. So with part A, or this question rather, there are two related parts. We have part A and part B. And when I do a question, I like to start with the required so that when I look at the question, I think of it from the required's point of view. So remember the beginning, I mentioned that some of the common mistakes that students make is on time management. So when I get the required, I would take a minute just to determine how much time I need to spend on each part of the required. So earlier on, I said we apply the 1.5 minute for every mark, but you can make it lower for yourself. So if we look here for required A1, I just want the red pen. So for required A1, if I were to determine the amount of time that I need to spend, I take the number of marks and I multiply by 1.5. This will give me 30 minutes or half an hour. Then I do the same for all the parts in the required. This one, I think it's about 6 minutes. For part B as well. This one would be 24 minutes. So this means that when I work through part A1, I need to spend 30 minutes, right? If I'm still busy with part A1 and 30 minutes has lapsed, I stop. I move on to the next question. If it takes me 25 minutes to complete part A1, then that's great. I will use that 5 minutes later on other questions. So remember that time management is crucial as you are writing. Okay, so now as you are reading the required, I said earlier on that Ms. Niswiswi actually likes to break it down as she is reading so that she doesn't miss any part. So we are going to start with A1. So A1 says that you need to determine, right? So that's the first thing that you need to do. It says you need to determine. And remember, when you see the word determine in our required, we mean that you need to calculate. So determine and calculate would mean one and the same thing, right? So you need to calculate the effect that transactions 1 to 5 will have on the taxable income or assessed loss. Okay, that's number 3. For who of Mabasa Nuts Pty Ltd, which is the company that we are going to look at in the question for the 2026 year of assessment. So I'm writing down these numbers because I'm trying to break down what is required or what is asked of me. The first thing that they want is a calculation. They say that I need to determine or I need to calculate something. What must you calculate? You need to calculate, number 2, the effect that transactions 1 to 5 will have on the taxable income. So since you have seen the question, you have seen that there are 5 transactions. So we want the effect of all those 5 transactions. If it happens that the question had 8 transactions and we say give us 1 to 5, then you give us 1 to 5. You don't give us 1 to 8, because if you do that, you are going to waste time. Number 3, we want the effect on the taxable income or assessed loss. So now when I see taxable income, I start thinking about that calculation or the framework of the taxable income. That slide that I showed you about the framework for taxable income. So the effect would mean that you need to tell us, or you need to show, since it's a calculation, whether something is an add back or whether something is a deduction. Number 4, for who are you doing this calculation for? You are doing it for Mabasa Nuts Pty Limited, which is the company that's in the question. If it happens that there are multiple taxpayers in the questions, we just want the taxable income for Mabasa Nuts, right? Number 5, for when should you do this taxable income? You should do it for the 2026 year of assessment. As you have read the question, you would have seen that the company has a March year end. What do you do when you see year of assessment? You write the timeline. So if it's a March year end, it means that this company's year of assessment will start on 1 April 2025 until 31 March 2026. So as soon as I see the year end of a company, I would write it down for myself so that I do not forget about it. When we read the required further, it says that commence your calculation with the preliminary taxable income of 1.9. So that's my number 6. I should not forget that when I start doing the calculation, I should start with this amount. Then it says provide reasons for nil effects. So that's my number 7. So this means that whenever you tell us that something is a nil effect, you do not just put a 0 because you won't get any mark. You need to give us the reason because we are asking for it. It means that marks are going to be awarded for reasons, okay? And maybe while I'm on this part, we often get a question about references to legislation. As you read this required, there is nowhere where we say provide references to legislation. You only provide references if you are required to. If you are not required to, then you don't have to write them down. You will see that sometimes or most times in our solutions, we actually put down the references, but we are only doing so for learning purposes, okay? So if the required says, give us references to legislation, one thing that you need to remember as well is that it has to be 100% correct. What I mean is, for instance, if we want you to reference to the general deduction formula, then you need to say section 11A. Do not just say section 11 because section 11 is broad. You won't get any mark. The last thing on the required, it says that Mabasa Nuts will make any election available to minimize their tax liability. So this sentence just simply means that if there are any election sections that may be applicable, then this company will elect to apply them. What are these election sections? For topic 3, what I can think of is we have, what is this? The scrapping allowance. We have section 11O. We also have the rollover provision.
Sorry, Ida.
Yes.
Sorry, Ida, to interrupt you. There's a request to zoom in a little bit.
On the question.
Yeah, just to zoom in a little bit, if possible.
Let me know if it's better.
Okay, I think that should be fine. Yes, that's fine.
Okay. All right. Thanks, Saj. So as I was saying that the election sections that you will find in topic 3, we have your scrapping allowance, which is your 11O, and we also have the rollovers in CGT, which is your paragraph 65 and 66. Okay, so if there are any election sections, it means that the taxpayer or Mabasa Nuts will elect to apply them. Then while we are on part A, maybe we can also speak about part A2 and look at the required for part A2. So part A2 says that you need to summarize, supported by calculations where necessary, all the VAT implications in transaction 5. So again, you need to read with understanding. For this part, they only want the VAT implications only for transaction 5, not for transaction 1 to 5. So if you give us the VAT implications for 1 to 5, again, you are going to waste time. And as you can see, there's only 4 marks available for this part. Then they say, ignore the time of supply. So now if we look at the question, and as I said, we are going to start with part A. So we are given the background information, and we also have the group structure. So if we read the background information, what we have here is that we have a company that's called Mabasa Nuts, which is short for MN. They say that it's a family-owned resident company that has its head office in Limpopo. And I'm just going to stop there, right? So remember, there was that slide that I had at the beginning that there are some common items that you need to look out for when you read a question. The first one that I spoke about is about the residency. So here they are telling us that MN is a resident company. So it means that whatever it is that you are looking at, it will be from a worldwide incomes perspective, right? The second item is to look out for the type of company. So far, we can see that Mabasa Nuts is a private company, and we see that it's a South African company because they say it's resident. But we are not sure yet if it's a small business corporation or not. Maybe they will tell us later in the question. So the company has its head office in Limpopo. It was founded by Kensani in 2007. Then other information that we have is that the company is a processor, which is not classified as a process of manufacture. So they process and they distribute nuts in South Africa, right? What I wanted to speak about here is this part that I'm highlighting about not being classified as a process of manufacture. This means that in the question, if ever you come across any manufacturing asset, it means that you will not apply section 12C, right? Because we are telling you that this process of nuts is not classified as a process of manufacture. So this means that section 12C will not apply. If it was the opposite, if they said that the process is classified as a process of manufacture, then you would consider section 12C or section 12E. Speaking of section 12E, if we read further, they say that MN is not a small business corporation as defined. So this means that it's not an SPC, 12E doesn't apply. So at this point, from reading this part of the required, I know that I'm dealing with a resident company. I know what they do, they process and they sell nuts. I know that the company is not a small business corporation. So it means that I'm dealing with a normal South African company, right? Then we have the company structure. Just want to move down. We have the group structure that's provided to us, and on the group structure, the information that we know is that the 65% of the shares that are being held by Kensani. Who is Kensani? Kensani is a resident. Again, worldwide income. Kensani is a resident and he's also the CEO of the company. We also have the Mabasa Family Trust. So the Mabasa Family Trust is a foreign trust and they hold 25% of the shares. So since Mabasa is a foreign trust, it means that it is a non-resident. And lastly, we have this 10%, which relates to individuals that are not connected to MN. So what I'm taking from this group structure is that I have realized that I am dealing with South African residents. I'm dealing with Mr. Kensani, who is a resident. There's also these 10% individuals that are resident. However, the Mabasa Trust is a non-resident. So that is something that I would write for myself so that I don't forget. It means that this trust is only going to be taxed on your South African source. Okay. The other thing, when you see a group structure or a company diagram, I will start to think about whether any of these parties are connected persons to each other or not, because we know that connected persons in tax, it can have an effect on certain implications, right? So remember to check the definition of connected persons that you will find in Section 1 of the Income Tax Act. It's one of those definitions that you should have highlighted for yourself, okay? If we go on further, it says that MN is a registered Category A VAT vendor. They make 100% taxable supplies, so you don't need to worry about VAT apportionment. It says that the company's year of assessment ends on the last day of March. Again, when you see year of assessment, I said what you should do is write yourself the timeline. 1 April 25 until 31 March 2026. So that's the period that you should focus on. Then it says that all amounts exclude VAT unless stated otherwise. So remember on this point, I said that you need to use VAT exclusive amounts if the taxpayer is a VAT vendor, right? When you calculate capital allowances for certain assets. So if it happens that in a question we gave you an amount including VAT, then you need to calculate the exclusive amount by applying the VAT fraction of 100 over 115. Okay, so if I was in your shoes when I was preparing for this question, these are some of the things that I would have highlighted for myself that I would have kept at the back of my mind as I am reading. Then other information, they said that you are now the accountant of MN and you've been appointed since the 2nd of Jan. The previous one had determined a preliminary taxable income of 1.9 million for the 2026 year of assessment. However, the below information that occurred in the last 3 months of the current year was not taken into account. So now let's get into each transaction. If we look at the first one, the first transaction says that MN had entered into an agreement with an advertising agency called Advert with Us on the 2nd of Jan. 2 Jan is my current year, it falls in the current year. In terms of this agreement, Advert with Us will advertise MN's products for the next 12 months on major highway billboards because MN would like to open a branch in the province. On the 2nd of Jan, MN paid Advert with Us a total amount of 1.7 million for advertising costs for the calendar year of 2 Jan to 31 December. So they paid for 12 months. So the question here is, since MN made payment to this company called Advert with Us, the question is, can MN get a deduction for this payment that they made of 1.7 million? And the answer is yes, right? However, you need to ask yourself, since they paid for 12 months, will they be able to get a deduction for the full amount that they've paid? And I just want to go to the chat as well, so that I can follow through. Okay, so I'm seeing a lot of you are saying no, it's a prepaid expense and therefore it's not deductible. So you are 100% correct, right? We do have a prepaid expense because they told us that MN entered into an agreement where they paid 1.7 for the next 12 months, right? And since we know that their year of assessment ends on the 31st of March, it means that they have paid in advance, right? They decided to pay the full advertising cost on the 2nd of Jan 2026. And therefore, we do have a prepaid expense. So with prepaid expenses, if we just recap on prepaid expenses, so the principles there with Section 23H or prepaid expenses is that Section 23H is a deferral section, meaning that it defers the deduction of certain expenditure that was actually incurred in terms of your 11A, 11C, 11D, or 11 cap A, right? Where the goods or the services will only be received after the end of the year of assessment. And if you look at our question, that's the case with the advertising costs because we have an expense that was incurred, therefore we have an 11A. However, the benefit of that expense will only be enjoyed after 31 March 2026. So when is Section 23H applicable? 23H says that that expense that you incurred, you can only claim a deduction on it to the extent that the goods or the services are supplied in the current year of assessment. The prepaid portion of the expense, meaning what was paid in advance, you are only allowed to get a deduction until the goods or the services that it relates to was received by the taxpayer. This slide here, it's a nice decision tree that summarizes the provisos of when Section 23H does not apply, right? The first one is Proviso AA in Section 23H. And it says that you need to ask yourself whether the goods or the services that were rendered will be done so within 6 months after year end. If your answer is yes, then section 23H does not apply, and then you can get a full deduction. However, if the answer is no, then consider Proviso BB. Proviso BB says that look at the aggregate of all the prepaid expenses and determine whether they are less than 100,000 or not. If they are less than 100,000, then you can get a full deduction. If, however, the amounts that are incurred are above 100,000, then you have a limit, right? And you can only deduct what you incurred in that specific year of assessment. The remainder will get disallowed in terms of section 23H. So the rule is that you need to apply the 6-month test, if I can call it a test. You apply the 6-month test first, your proviso AA, and thereafter you apply the 100,000 test. So now if we go back to our question, and we see, or we need to determine whether section 23H is applicable or not. Remember the principles or the rules? I just said that you need to firstly assess in terms of proviso AA whether the service will be rendered within 6 months after year end. What do we know about the prepaid expense? We know that it was paid on the 2nd of Jan, and we know that our year of assessment is 31 March. So it means that there's 3 months that's in the current year of assessment. It also means that there's 9 months that is prepaid. Therefore, this means that the first test is not met because the service will be rendered more than 6 months. It will be rendered 9 months. If you think from 31 March to 31 December, that is more than 6 months, right? Then you do your workings, you split your current year expense and the prepaid portion. So the current year expense will be the 1.7 million, and you multiply it by 3 months for the current year, which will give you the 435. I see Fanelo has the answer already on the chat. So the 3 months expense will amount to 435. The prepaid portion for 9 months will amount to 1.3 million. So since we know that this 435,000 was incurred in the current year of assessment, we don't have any issues with this one. You can get your deduction for that 435, right? So you bring it in your taxable income calculation. Now we need to determine whether we can get a deduction for the 1.3. The second test, or proviso BB, says that you need to determine whether the aggregate of all your prepaid expenses are less than 100,000 or not. And since you have read the question and you know that this is the only prepaid expense that Mabasa NAS has for the year, it means that there are no other prepaid expenses that you can aggregate with, so you are only looking at this amount of 1.3 million. This 1.3 million, clearly we can see it's way above the 100,000. Therefore, it means that section 23H will disallow the deduction for this amount in the current year of assessment, right? So when you give us your answer, when you present your answer in the solution, you will show that you are going to claim the 3 months, which is the 435,000. When it comes to the 1.3 million, you need to give us a reason as to why you are saying that you're not going to claim a deduction for that, and you refer to section 23H, which is the prepaid expense. Okay, so that's that for transaction 1. Transaction 2 has got to do with leases, and I will not go into the details of leases. There's a pre-recorded session for leases that you can go through at your own time. So for this particular transaction, what we know is that MN, they decided to lease a new machine because the old one was damaged. Then they leased this new machine on the 1st of Feb 2026. They entered into a lease agreement with a company called Peg-It, and it had the following terms, right? So the terms of the lease are that it's for a period of 2 years, starting on the 1st of Feb 2026. There's a once-off lease premium that amounts to 44,500 that was paid on this date of 1 Feb 2026. There's also the lease rentals that amount to 7.2 per month. So for this question, this one was a straightforward lease transaction. So here you had to recognize that there are two things. We have the lease premium and we also have the lease rentals, right? So starting with the lease premiums, as we are told, this is a once-off lease premium that was paid on the 1st of Feb 2026. So I ask myself a question on whether Mabasa Nuts can get a deduction for the lease premiums, right? So there's a once-off premium of 44,500 that they paid. The question is, are they able to get a deduction for the lease premiums? And yes, the answer is yes, in terms of section 11F, right? 11F is the deduction for the lessee, which is MN. So when you deal with leases, it's important that you identify which party is the lessor and which party is the lessee, because the tax implications for the two are different. And there's actually a nice summary in Edu8 where we show you the different in tax treatment for a lessee and a lessor. So in this question, Mabasa Nuts is the lessee. And since they are the lessee, they can get a deduction for this lease premium in terms of section 11F. The lessor, which is the party that is receiving the premium, which is this company called Peg-It, they have an obligation to include in their gross income the full premium that they received in the year of receipt in terms of paragraph G of the gross income definition. So as I said, this is a straightforward transaction. The only mistake that a lot of students made last year is that they forgot to apportion. They forgot to apportion the lease premium over the lease period with that maximum of 25 years. And remember, you apportion it for a part of the year as well. So many students, they just took this 44,500 and they deducted it as it is, which is wrong. You need to apportion it over the lease period, right? So it's 44,500 divided by 2 years, which is the lease period. Then you pro rata it. And you get your amount. That's one easy mark. We also have the lease rentals. So the lease rentals, it's a normal 11A deduction. You multiply it by 2 from 1st of Feb until 31 March. Okay, so that's transaction 2. Transaction 3 says that on the 1st of March 2026, which is in the current year of assessment, MN sold one of its old trucks. So there was a sale of a truck in the current year of assessment, right? Whenever you think about a sale of an asset, it should trigger something. So when you see a sale of an asset, what does it trigger? And this is what you learned in topic 2. So here we have a situation where the company sold one of its trucks. 100%, you're all getting it right. So when you see a sale of an asset, it is a trigger for CGT, right? So here, what we have is that the company, they sold their old truck and they sold it for 467,000 rands. So I have proceeds of 467. So they sold their old truck and they decided to buy a new truck from a local supplier at a cost of 600,000 to replace the old one that MN had used previously. So here we have a situation where the company decided to dispose of their old truck and they want to replace it with a new one. So the question for you guys is, which section or which paragraph will come to mind when a taxpayer voluntarily replaces an old asset with a new one? Okay, so think about CGT, think about the rollover provisions. I actually had 2 consultations this past week on this one. So without picking on Togozile and Nontsikelelo, I hope that they're in class. Which paragraph or which section would you think about? Okay, I'm seeing paragraph 65, 66, 66. It's one of the two, but yes, you're on the right track, right? So what you had to recognize is that a taxpayer, they can elect to apply the rollover provisions of paragraph 66. And we will get into why it's 66 and not 65. So they can elect to apply paragraph 66 in order to defer any recoupment and any capital gain if the requirements in 66 are met. Because we have a voluntary disposal where an old asset was replaced with a new one. Now, what if this asset was not voluntarily disposed of? What if this truck was stolen? What if it was destroyed? Would you still consider the rollover provisions? And at this point, I think, Saj, you can bring up the second question of the poll. I just want to take a quick pause to drink water, then I'll be back. Okay, thanks, Saj. I see the poll. So as I said before I paused, is the question that I'm asking is whether or what provision or which paragraph would you consider if the asset was stolen or if it was destroyed in a fire, for instance. Okay, and I see the votes are coming in. Okay, a lot of the students are saying yes, you would still consider the rollover provisions in terms of paragraph 65. And you are all 100% correct, right? So if we just have a quick recap on the provisions of paragraph 65 and 66, is that, as I've mentioned, that in terms of paragraph 65 or 66, a taxpayer can elect to defer any recoupment and capital gain if they meet the requirements in those paragraphs. So the first thing that you need to note is that these are election paragraphs, meaning that a taxpayer needs to elect to apply them because it would reduce their tax liability. So this particular slide just provides the requirements of when you apply paragraph 65 or 66, right? So paragraph 65 applies to what we refer to as an involuntary disposal. Involuntary because this disposal results or happens because an asset was destroyed or an asset was stolen or there was some destruction with that asset. And important to note that the proceeds needs to accrue to the taxpayer. So for instance, if there's proceeds that the taxpayer has received from an insurance company as compensation, then they need to accrue to the taxpayer. So there's two requirements for involuntary. It's an involuntary disposal and the proceeds needs to accrue to the taxpayer. And also note that paragraph 65 applies to both movable and immovable assets. On the other hand, we have paragraph 66. So 66 applies to a voluntary disposal. This means that here a taxpayer intentionally wants to replace an old asset with a new one, which is the case for Mabasa Nuts, where they replaced the old truck with the new truck. Then these are the requirements that you need to meet. So all these requirements need to be met. The first one says that the proceeds must be equal to or must exceed the base cost of the asset. So this means that you need or you must have a capital gain. If you end up with a capital loss, then this paragraph cannot apply. Second requirement, the full amount that you received from the disposal, you must use it to acquire one or more replacement assets. So this means that the full amount that you would get from the insurer, if you're in paragraph 65, you need to use that full amount to purchase the new or the replacement asset. 3, the contract for the acquisition of the asset must be concluded within 12 months. And 4, the replacement asset must be brought into use within 3 years from date of disposal. So these are the requirements that all needs to be met before you can apply paragraph 65 or paragraph 66. If you meet all these requirements, then the rule is that you need to defer a capital gain, or you defer the capital gain and a recoupment and you spread it over the same period as the replacing asset. So what this means is that when you defer the recoupment or the capital gain, you use the same allowance or the same write-off period that you would apply for the replacement asset. For example, if you have a Section 12C asset that you purchase to replace the old one and you meet the requirements in 65 and 66, then you are going to use the 20% allowance rate if it's a used asset. So basically, what paragraph 65 and 66 says is that let's not take the full recoupment or let's not take the whole capital gain, but let's defer it and put it in piecemeal over the period. And that is why one of the requirements is that the proceeds must be more than the base cost. Because when you have a capital gain, or rather, if you have a capital loss, then you wouldn't want to delay a deduction, but you would rather want to delay an inclusion in your taxable income. So going back to our question, let's see if indeed the requirements of paragraph 66 are applicable. So what we know so far from the information is that we have an old truck that was sold for 467,000. So I have the proceeds for the old truck. And we also have, let me use a different colored pen. We have a new one that was purchased for 600,000. So for the new asset, I have the cost of 600,000 rand. Then if we read on further, they say that MN used the proceeds from the sale to partly fund the purchase of the new forklift truck, which was brought into use on the 16th of March. So this sentence means that the full amount of the proceeds, that 467,000, it was used to fund the purchase of the new truck. So if you think about all those 4 requirements that we looked at, it meets the second requirement that says that the full amount of the proceeds must be used to purchase the replacement asset. What we also gather from this part of the question is that this new asset or this new truck, it was brought into use on the 16th of March. And we know that the old one was disposed of on the 1st of March. So this company didn't waste any time to replace it. So we also meet requirement number 3 that says that the contract for the purchase of the new asset must be concluded within 12 months. We also meet requirement number 4 that says that the asset must be brought into use within 3 years. They brought it into use on the 16th of March, which is 16 days in that year of assessment. When we read on further, it says that the old truck was purchased 6 years ago on the 1st of June 2020 for 345,000 rand. So I have the base cost for the old truck as 345,000. There's one requirement that we didn't determine if we meet, right? So that one requirement says that you need to have a capital gain. Does the proceeds exceed the base cost? And if we look at the old asset, we know that the proceeds are 467 and the base cost is 345. So it's clear that in this instance, we do have a capital gain, and therefore we also meet requirement number 1. So we meet all the requirements in paragraph 66. Therefore, it means that Mabasanas can elect to apply this paragraph because we told you in the required that they would make any election available to minimize their tax liability. Then the other thing that I wanted to point out here is that we also have the replacement asset or the new truck. So it means that the company can also claim capital allowances for this truck. And since this truck is a movable asset, it's not a manufacturing asset, it's a movable asset. So which capital allowance should MN or Mabasa Nuts claim in respect of this truck? Precisely, it's section 11E. Hey, and I see Mbalentle said section 12C. Remember that section 12C is not applicable. It's not a manufacturing asset, and remember they told us that the process of nuts for this particular company is not classified as a process of manufacture. Therefore, you will not consider section 12C, but 100% to everyone that said section 11E is applicable. So briefly, if we look at the slides on movable assets, and I hope you guys don't kill me because of time, but if we look at the slides on, let me just share. On capital allowances for movable assets, just remember the principles here is that, firstly, what I want to point out is that for your purposes of your studies, we only have 4 movable capital allowances that are in scope for you guys. We have section 11E, we have 12B, C, and 12 cap E, right? So these are the only 4 that you need to study that are in scope or in the syllabus for you. Principle-wise, remember that the cost should exclude VAT. So what I mentioned at the beginning, that you need to consider section 23C that says that you need to use the VAT exclusive amount. When we look at section 11E, you use the cost or the value of the asset. But for these other 3 sections, you need to use the lesser of the actual cost of acquisition or the cash cost under an arm's length transaction. This simply means that you need to use the lesser of cost or market value. You include any cost of installation, shipping costs, delivery, import duty, and moving costs, but you exclude interest and finance charges. Then we have this nice slide. I don't know how many times I said there's so many nice slides, but this is one of my favorite slides. I like decision tree diagrams. They help me to remember information. So for this one, this is a decision tree diagram for the 4 sections that I said are in scope for you guys. So whenever you are dealing with movable asset allowances, you first have to consider if that asset belongs to an SPC, right? If it does belong to an SPC, then you know that Section 12 Cap E is applicable. And remember I said that in topic 3, we are going to be clear in the question on whether you are dealing with an SPC or not, right? What are the principles? If it's an SPC and it's a manufacturing asset, then you can claim 100%. If, however, it's a non-manufacturing asset, then you claim the 50, 30, 20, right? And we do not apportion. So here, Section 11E can be claimed if it's more beneficial than Section 12E. Going further down on the decision tree, if it happens that the asset does not belong to an SPC, then you need to ask yourself if it is a manufacturing asset. If yes, it's a manufacturing asset, then you consider Section 12C. Principles of Section 12C, you need to determine whether you are dealing with a new and an unused asset, or if you're dealing with a used asset. If it's a new and an unused asset, the allowance rate is 40, 20, 20, 20. However, if it's a used asset, then you get 20% over 5 years. And again, we do not apportion. For Section 12C, here the taxpayer may not elect to apply 11E if it's more beneficial. Okay, unlike Section 12E. Going further down, if the asset that you're looking at is not a 12E or it's not a 12C, then you ask yourself if it's an asset that's used in the production of renewable energy. And if that's the case, then you would consider Section 12 Cap B. Okay, and I see we didn't include in the slide the implication of 12 Cap B, but the principles for 12B allowances is that you need to distinguish between assets that are used in the generation of electricity. If it's from a, what do they call it? A PV, a photovoltaic solar energy that exceeds 1 megawatt, then you get 100%. Then for any other assets that are used in the renewable energy, you get the 50, 30, 20. Here again, we do not apportion. Then the last one. If none of these 3 are applicable, then the default would be that you apply the 11E, your wear and tear allowance. With wear and tear, what you need to remember is that the write-off period for wear and tear, you find them in interpretation note number 47, and that's something that we will provide to you in a question. You must remember that with wear and tear, this is the only section where you need to apportion. And if you have a small or a loose asset that has a cost of 7,000 rands or less, then you can write it off to 1 rand. So whenever we see movable capital allowances, the only place where we want to see an apportionment is if you are dealing with a Section 11E or the wear and tear. Okay, so at this point, I think we can have a look at the solution for transaction 3. It's easier to explain it by using or looking at the solution. So with transaction 3, we said that there was a sale of an asset, therefore you consider CGT. When you consider CGT, you need to consider if you have a recoupment or a scrapping allowance. So that's where you're going to start. They told us that we have an old truck. So this old truck has a cost of 345,000 rands. The 11E allowances, they fully written off because that truck was purchased 6 years ago. So in the current job assessment, it gets fully written off. Then you end up with a nil tax value. Then you determine your recoupment. The principle is that your selling price is limited to the cost price. You take that cost, reduce it by the nil tax value, and you get your recoupment. The question then is, do you include this full recoupment in your calculation? And the answer to that is no, because we have established that paragraph 66 of the 8th schedule is applicable. So it means that you are going to defer the recoupment and the capital gain. How do you defer it? You use the same period as the asset that was being replaced. What's that period? On the question, they told us that the write-off period for these trucks is 4 years. So your write-off period is 4 years. And remember, since you are dealing with 11E, you need to apportion. The new asset was brought into use on the 16th of March. So when you count from 16 March to 31 March, you have 16 days, right? It's not 30 days. It is not, what is this? 1 month. It's exactly 16 days. So do not be afraid to count using your hands, right? Do not be lazy to count. A lot of students last year, they used 1 month. But this new truck was not purchased on the 1st of March. It was purchased on the 16th of March. So it's 16 days in the current year of assessment. So this means that you will defer your recoupment over 4 years at 16 days over 365. Okay, and I see in the chat, Ntlamulo is asking, when do we use the 40% to defer the recoupment? Remember, I said when you defer, you use the same write-off period or the allowance rate of the replacement asset. So it will be, you will be guided by the replacement asset. If the replacement asset was a manufacturing asset and Section 12C was applicable, then you apply the Section 12C rates, and that's where the 40% that maybe you have seen in questions would come in. It would apply to a Section 12C on a new asset. You would defer that recoupment and the CGT or the capital gain using 40%, which is the allowance for the new asset. Okay, so now we have determined the recoupment. CGT, you apply the normal CGT principles as you know them. Your proceeds, the 467 less the recoupment, reduce it by your base cost, and you get your capital gain. Similarly, with the capital gain, you defer it using the same period, right? What do you do with the capital gain? You aggregate it with your other capital gains and losses. The other thing for transaction 3 that you need to remember is that there's a new truck, right? So do not forget to claim the 11E allowances for the new truck using the same rate of 4 years divided or multiplied by 16 over 365. Okay, so I see our 2 hours is over. So I just want to quickly rush through transaction 4 and transaction 5, and then the text 4861 students can excuse themselves. So with transaction number 4, transaction 4 related to trading stock. It related to closing stock to be specific. So here they told us that MN determined that the closing stock at the end of the current year of assessment amounted to 900,000 inclusive of VAT. The market value of this trading stock at year end was 5% more than the cost price. The opening stock and cost of sales have already been correctly accounted for in the 1.9 million. So it means that you don't need to worry about the opening and the cost of sales. In terms of closing stock, the principle there is that you add it back in terms of section 22(1) of the Income Tax Act. At which value do you include it, right? The value for the closing stock will be the cost price. or you can use a lower value if the commissioner has approved that lower value. So for this question, you would need to choose which value to use, right? So they said that the market value is 5% more than the cost price. So I don't even need to do a calculation for that. They already told me that it's more. Then by default, it means that I will use the cost price of this 900,000. But would you include or add back this 900,000 as it is? And the answer to that is no, because we need to use exclusive amounts. Therefore, it means that you will take that 900,000 and you multiply it by 100 over 115 to get the VAT exclusive amount. And that's your answer. Thanks, Saj. I see you put up the poll for question 3. I just skipped through it because I'm looking at time. Then for the last transaction, for transaction number 5, remember in transaction 5, you need to also consider required A2 that says that you need to look at the VAT implications. So when you answer this part, you might as well answer required A2 as well. So transaction 5 says that on the 31st of March 2026, so this is again in the current year of assessment, one of MN's clients went insolvent and MN decided to write off the debt as irrecoverable. So this was in respect of a loan and in respect of trade debt. So for this transaction, we have a foreign customer whose debt was written off as bad debt, right? So for income tax, which sections comes to your mind when you see bad debt or when you see a foreign transaction? Okay, let me quickly check the chat. Yeah, I'm seeing a lot of different answers. Section 19, 31. 31 we will get to in part B. 31, remember 31 applies when you are dealing with a resident and a non-resident. 24J, there's no interest. Okay, so I see we have different answers for this one. So let me take a few minutes just to get into it, right? So when you see a bad debt, remember bad debts are governed by Section 11I. When you see foreign transactions, you need to consider Section 25D and 24I, right? So that's on the income tax side. We also have VAT that we need to consider in required A2. So for VAT, the section that you would consider that governs bad debts would be Section 22 of the VAT Act. Okay. So if we consider or look at the slides quickly on 11I, 11I or bad debt is a special deduction. It's what we refer to as a special deduction. And when we speak about special deductions, we speak about those deductions that are either not deductible in terms of the general deduction formula, or they are prohibited, or it's an additional deduction, right? Each of them would have their own rules and principles. What I wanted to remind you of is the first thing, if both a Section 11A and a special deduction apply, then the special deduction takes preference. So you always start with the special deduction. The second thing is that in terms of Section 23 Cap B, no double deduction is allowed. So you cannot get a deduction twice unless if it's specifically provided for, right? Like your Section 12H for learnerships. The learnership allowance is an additional deduction for employers. over and above the Section 11A deduction that they can get. Then this slide is basically just a summary or a list of all the special deductions that are in your syllabus. So please ensure that you have flagged them, you have highlighted them in your legislation. Now, in the question, we have correctly ascertained that 11I is applicable because we are dealing with bad debts. Principle for bad debt or 11I is that you can get a deduction if the debt has become bad during the year of assessment and that amount was included in the taxpayer's income either in the current year or in the previous year of assessment. So this would mean that if there are any loans that are irrecoverable, that you will not get a deduction for them because they were never included in income. Okay. Then the other thing that I quickly wanted to go through is since we have established that we have a foreign bad debt, then you have to consider the provisions of Section 25D and Section 24I, right? Foreign transactions is one of those topics that is my favorite. Similar to CGT, it's a favorite topic. And I'm sure that whenever you have seen a question in topic 3, that 90% of those questions, you can expect to find a foreign transaction, you can expect to find a CGT question. So you need to be comfortable with foreign transactions. And again, we also have the pre-recorded videos where you can go through the detailed examples of foreign transactions. Just quickly and briefly, the principles that you need to remember without getting into too much details when we look at Section 25D. So Section 25D, we use it to convert the foreign currency amount into rent. So if you have any foreign currency receipts or expenses, then you convert them at an exchange rate on the transaction date. In terms of which rate you use, this depends on whether you are a company or you are an individual. The rules is that if you are a company and a trading trust, then you need to use the spot rate on the transaction date. But remember that for interest, since interest is something that accrues on a daily basis, then you need to use the average rate. If you are an individual or a trust that's not trading, then they have the option to either use the spot rate or the average exchange rate. So obviously they would choose the one that is better between the two. So basically 25D, we use it to convert the foreign currency. That means that you want to get the cost price of that asset or the trading stock into your books. You get it at the spot rate if you are a company, or use spot rate or average if you are an individual. Okay. However, there is a caveat in paragraph 43(1)(a) of the 8th schedule that contradicts Section 25D. Paragraph 43(1)(a) allows companies and trading trusts the option to use the average rate only when they are disposing of an asset in foreign currency. So this only applies if you are disposing of or selling an asset. The companies have an option to either use the spot rate or the average exchange rate. Then 24I, you need to consider if there's any foreign exchange gains and losses. You need to calculate those foreign exchange gains and losses between the 3 dates, between your transaction date, translation, and your realization date, right? What I want to get to specifically in this question is Section 24I4, which is in respect of bad debt or irrecoverable debt. So when it comes to the bad debt in foreign amount, there's actually a specific provision that you find in Section 24I4. And 24I4 says that subject to Section 11, if you have a bad debt and that relates to an exchange item, then any amount of foreign exchange gain that you had previously included in income, you need to reverse it or you need to deduct it on realization date. Similarly, with the opposite, if you have a foreign loss that you previously deducted, then you need to add it back, right? Subject to 24I is subject to 11. So it says that if the requirements for a deduction are met in 11I, then 11I would take precedence over 24I. This simply means that 24I4 is not applicable on your normal trade debtors because they would get a deduction in terms of 11I. However, 24I4 will apply to a staff loan, for instance, because with staff loans, 11I does not apply. And for this one, you can please have a look at example 15.13 in your Silk textbook. But we'll quickly look at the application of that in the question. So in the question, remember the first part, we had the loan. We have a loan of 80,000 ZMW in Zambia. So it's the Zambian kwacha that was given to this client on the 1st of Feb 2025. No interest was charged on the loan, and they say that there was a forex gain of 4.8 that was recognized in the previous year. So from an income tax point of view for part A, when it comes to the loan, in terms of section 11I, Mabasa Nat will not be able to get the deduction because we are saying that it was never included in income. Therefore, it means that this loan is capital in nature. And since it's capital in nature, then don't forget to consider the CGT on that loan. The proceeds will be nil, and the base cost, you can either use the spot rate or the average rate because of that paragraph 43.1. Then you end up with a capital loss. Now, since I know that this is the last CGT in the question, I will conclude on CGT. I aggregate all my capital gains and my capital losses. So the only other capital gain was with respect to the truck. So I aggregated, I get a capital loss. And since I have an assessed capital loss, I carry it forward to the next year of assessment. If you ended up with a net capital gain, then you would include it at 80%. Okay. So we have dealt with the bad debt aspect of the loan. But there's also foreign transaction that we need to consider for the loan. So this loan will have a foreign exchange difference between the first translation date, which is the end of the previous year of assessment, and the second translation date, which is the end of the current year of assessment, right? So you are going to end up with a foreign exchange loss that you're going to deduct from the calculation. So with your foreign exchange differences, usually we award 2 marks for that. You get half a mark each for identifying the correct rate, and you get a mark for correctly noting whether it's a loss or a gain. Okay. Then the last part for the loan, I said we have a provision in 24I4 that says that that's applicable to irrecoverable debts, right? So that provision, I said it's subject to section 11I. If 11I is not applicable, then you can apply 24I4. And the implication is that you need to reverse out your foreign exchange differences. If you looked at the question, they told us that in the previous year, there was a foreign exchange gain that was recognized. So since we are saying 24I4 is applicable, you would need to reverse out that 4.8. And that's what we have here. And also the current year, you would reverse the loss by adding it back. So that's the income tax side of it. The VAT, remember to kill 2 birds with 1 stone. You are dealing with the loan, so give us the VAT implications for the loan as well. Since it's a loan, it's a financial service, it's an exempt supply. So that's what you're going to write. And I know I'm flying through this question, just looking at the time. The last part on transaction 5 is the trade debtors. So here we have a trade debt that amounts to 362 for nuts that were sold on the 12th of September. Then they tell us that the proceeds for the sale have already been included in the taxable income for the year. So if that was not the case, if the proceeds for the sale were not included, then you would have to include it in your gross income at the transaction date, the date that the transaction occurred, which is the 12th of September. What we need to consider, however, for our purposes is whether they can get an 11I deduction for those trade debtors, and the answer is yes, because the amount was previously included in income. Since it's a foreign debt, then you need to convert it into rands, right? And you use the rate on the realization date. The realization date is the date that it was written off. So it means that you are going to use the rate on the 31st of March, 2026. And that's what we have on the solution. So the bad debt written off is deductible in terms of 11I at the rate of 65 cents, which is the rate on the 31st of March, 2026. Then don't forget about your foreign exchange gain or loss. It will be the difference between the transaction date and the realization date, resulting in a loss. Then on the VAT aspect, with regards to the trade debt, remember this was as a result of an export. So a trading stock was exported. An export for VAT purposes is a zero-rated supply. Therefore, it means that there would be a nil output tax. And earlier on, we established that Section 22 of the VAT Act applies in respect of bad debts. So it's something that you would note. If we apply Section 22 to these trade debtors, we realize that actually Mabasa nuts will not be able to claim this input tax deduction because we said that there's no output tax or there's a nil output tax because the export was a zero-rated supply. So that is something that you would note in the solution. Okay, so that's basically the end of part A. And at this point, I think the text for 861 students can excuse themselves for the day. So thank you very much for taking the time to join us, and I hope that you have learned a thing or two. I'm just gonna ask Sajida if she can just post the link to the evaluation form. The next part, and I'll hear from what you guys prefer. So the next part is part B, which relates to transfer pricing. As I said before, transfer pricing is only in the syllabus for text for 862 students. So since we have went over the time, I would like to hear from the text for 862 students if they would want us to finish this part on transfer pricing, or if this is where you want to stop for today. Saj, if you can please post the evaluation form for the level 1 students as they excuse themselves for today.
Ida, there's a lot of students that are requesting that we continue. So I think if anyone needs to write somewhere, they'll rather listen to the video. They'll rather watch the video.
Okay, thank you so much, Tungu. Okay.
The evaluation form is posted in the chat, so students kindly fill it out. Thank you.
Thank you so much, Saj. All right, so I think I'll take 10 minutes or so just to quickly go through part B. As I said, it relates to transfer pricing, which is only for CTA2 students. So with part B, if we quickly look at the required. So part B says that you need to write an email to Kensani Mabasa advising him of all the tax implications that he should consider if he were to provide the loan to the trust. So now I'm assuming that we have all went through the question, right? So the required is asking for all the tax implications, except it says ignore VAT and estate duty. So it means that you need to think about all the tax implications from your income tax, donations tax, dividends tax, etc. Whichever tax implications are applicable to Kensani Mabasa is what you need to consider, right? Then it says provide supporting calculations where necessary. And we also have a PVAA mark for the layout and structure. So since we said write an email, this PVAA mark for layout and structure is basically awarded for you for giving us the format of an email. So do not be lazy to write that format as you know it of an email. What I wanted to remind you of is that you must not identify yourself. By identifying yourself, I mean that you must not write your name or your email address or your student number when you are giving us this email, because you will not get the PVAA mark, right? So you should never ever identify yourself. And this is also important when you get to your IAC board exams. So please don't forget about that. Okay. So now, looking at part B, this was a straightforward question. Well, only if you knew or only if you were able to identify that section 31 is applicable. So in the first part, there's a nice story that they provided to us. So basically what happened here is that we have a foreign trust, right? We have the Mabasa Family Trust, which is a foreign trust, which was founded by Kensani with his 3 South African resident minor children that are the beneficiaries. Then what happened is that there was an opportunity that arose for the trust to buy shares in the UK private company. However, the trust did not have the necessary cash reserves to purchase the shares. And then Kensani considered to provide a loan advance of 3.5 million. And this advance was made on the 1st of February, which is in the current year, at an interest rate of 3%. So basically, short story is that we have Kensani, an individual that provided a loan to the trust, which is a non-resident, right? Provided this loan on the 1st of February 2026, which is in the current year. And the question said, give us the tax implications. So what you needed to recognize as you read the required, it said that write an email to Kensani advising him of all the tax implications. So the importance of reading the required, you are providing the tax implications for Kensani. Kensani is an individual. Kensani's year end will end on the 28th of Feb 2026. It doesn't end on the 31st of March 2026. And that's one of the first mistakes that students made last year. They used the year of assessment of 31 March, which is wrong. You had to recognize that you are dealing with an individual, which is Kensani, and an individual's year end for 2026 ends on 28th of Feb 2026. Okay. So this question was actually answered very badly last year, and unfortunately, if you missed that this was a transfer pricing question, then unfortunately you would have scored very, very few marks. The other thing that we tested on this question was in, the Section 7C amendment. So last year there was a recent amendment on Section 7C5, which is what we also tested in this question. So just a tip from my side for today. If ever you didn't hear anything else that I said during the course of the session, just remember that you need to pay special attention to new legislative amendments, because we actually love to test new legislative amendments. So please do not go over them when you see them in your study guides. You need to be aware of any new legislation that has changed from previous years, okay? Okay, so as I said, this was a transfer pricing question, and just brief principles on transfer pricing or Section 31. So Section 31 applies to what we call an affected transaction that leads to a tax benefit. So you need to know the definition of an affected transaction, and you will find it in Section 31. So an affected transaction is defined to mean a transaction that is entered into or concluded between connected persons or associated enterprises. But you don't need to worry about this associated enterprises because it's not in your syllabus. So it's a transaction that's concluded between connected persons under conditions other than arm's length conditions between independent persons. So it's basically a transaction between connected persons. The conditions are not at arm's length, and it's between independent persons, and those persons can either be a resident and a non-resident. So whenever you find a transaction that's between a resident and a non-resident, then consider if Section 31 applies. In order for you to consider if 31 applies, look at the definition of affected transaction to see if it meets that definition. So the key words for me when I look at an affected transaction definition is connected person and conditions that are not at arm's length. Connected persons. I think I mentioned earlier on that it's defined in Section 1 of the Income Tax Act. So remember to highlight the definition for yourself. Just pay attention to Section 31. There's a rule on connected persons specifically for financial assistance, right? So please go through the slide and see the bit of change regarding the definition of connected persons for financial assistance. Okay, so as I said that in order for Section 31 to apply, there needs to be an affected transaction, meaning, do you have a transaction between a resident and a non-resident? Are the parties connected persons? Is that transaction an arm's length transaction or not? And does it lead to a tax benefit? If your answer is yes, then it means that you have an affected transaction and you fall in Section 31. The implication of that is that you need to calculate the taxable income of the person that is receiving the tax benefit by applying the arm's length conditions to the transactions. This means that you need to calculate their taxable income as if the transaction was an arm's length transaction. And this is where now Section 31(2) comes in. 31(2) is also called the primary transfer pricing adjustment. We also have Section 31(3), which we refer to as the secondary transfer pricing adjustment. 31(3) says that difference in taxable income between the arm's length amount and the non-arm's length amount. So basically the difference that you would have calculated in the primary transfer pricing adjustment, you need to treat it as a dividend in specie if that resident is a company, or treat it as a donation if that resident is not a company. Meaning, if you are dealing with an individual, then you treat that difference as a donation. And both these taxes, they have the rate of 20%. So do not forget to provide the timing as well. So it's payable on the last day of the 6-month period following the end of the year of assessment. So remember that when you do a discussion question, you must always include the timing if it's applicable. Okay, then we have another nice decision tree diagram that will help you to identify if section 31 is applicable or not. So quickly going through the question to see if we can apply section 31. Remember that in the required, they said, give us the tax implications for Kensani, which is an individual. So the first thing that I will think about for Kensani, since Kensani is providing a loan, it means that he will potentially receive some interest income, right? So I will speak about interest income as my first item. Kensani, he is a resident. And remember, we said residents are taxed on worldwide income. So this interest, this foreign interest that he's going to receive from this foreign trust, it would deem to accrue to him, and you should include it in his gross income. Okay. At which amount? Remember, you need to provide supporting calculations. The calculation is easy. Remember, I said earlier on that Kensani is an individual. His year of assessment ends on the 28th of Feb. And he provided this loan on the 1st of February 2026. So it means that the amount of the interest will be calculated as the 3.5 million multiplied by the rate of 3%, and then you apportion for 28 days in February. So this is the amount of interest income that Kensani would include in his gross income. And remember that interest accrues on a daily basis. So you need to remember to use days when you are calculating interest. So you get your 2 easy marks there for the discussion and for the amount. Now, the second thing that I'm going to consider is the applicability of Section 31, the transfer pricing. The reason I'm considering transfer pricing is because I got triggered when I saw that I'm dealing with a non-resident, which is the trust, and I also have a resident, which is the individual Kensani. What are the requirements? You determine if there's an affected transaction, right? Firstly, definition of affected transaction says, are you dealing with a resident and a non-resident? And the answer is yes. We have a resident, which is Kensani, and we have the non-resident, which is the trust. Secondly, consider if the two parties are connected persons. And the answer is yes as well, because they told us that the beneficiaries of the trust are Kensani's children, and he is connected to his children. So therefore, it means, or it makes him to also be a connected person. Okay, so remember to highlight the definition of connected person in section 1. The third thing, you need to consider if the terms of the transaction are arm's length or not. So by this, we mean, are they market related or not? And you have to read the question in order to determine that, right? So they told us that Kensani provided the loan at a rate of 3%. But if you look here at the additional question, they are telling us that the market-related interest rate for a similar loan is 6.5%. So this tells us that actually Kensani charged a low interest of 3%, which is not market-related. Therefore, we cannot say that this transaction was at arm's length. And as a result, it meets the definition of affected transaction in section 31. So everything that I have written here is what you're going to write in your answer. You apply the scenario to the requirements. You don't just dump the theory. If you just tell us, if you conclude in your head that yes, they are connected persons or yes, there's an affected transaction, then unfortunately you will lose out on a lot of marks. Remember, apply and put down your thoughts on paper. Then, since it's an affected transaction, you need to determine if it leads to a tax benefit. So the answer to that is yes, there is a tax benefit because Kensani gets the tax benefit of including in his gross income the interest at a low interest rate of 3%, as opposed to including it at a market-related interest rate of 6.5%. So at the end of the day, he would include a lower amount of interest in his gross income. So since we are saying that Section 31 is applicable, then you need to discuss the implications of it. The implications of it, if you remember, there's two. I said that you need to tell us about the primary transfer pricing adjustment, which is in Section 31(2). Basically, what needs to happen for Kensani is that he now has to include an amount which is equals to the arm's length or the market related in his gross income. So remember the transfer pricing, the primary transfer pricing adjustment is the difference between what he had actually included and what he was supposed to include. So that at the end of the day, he gets taxed as if this was an arm's length transaction. So it means that the primary transfer pricing adjustment will basically be the difference between the market related interest and the actual interest. And that's what he needs to include in his gross income. The second implication is the Section 31(3) adjustment, the secondary transfer pricing adjustment. And it says that take that difference and treat it as a donation because you are dealing with an individual. If you were dealing with a company, then you would treat it as a dividend. Okay. So since it's a donation and since we said give us all the tax implications, then you can discuss donations tax implications that you learned in topic 1. So you will give us the 20%, you will consider if there's any exemptions that are applicable, you will give us the timing as well, okay? Then the last thing that you might have picked up or considered in this transaction is the provisions of Section 7C. And if I'm not mistaken, I think you will learn about Section 7C later on in topic 5. So Section 7C here, it's applicable because there was a loan that was made by a natural person to a trust and both parties are connected persons. Then you had to consider the exemptions in Section 7C. And if you go through the exemptions, you had to recognize that Section 7C(5)(e) was applicable, and that's what you had to bring into the discussion. Okay, so please go through this question again. Make sure that you are comfortable with the what is this? With transfer pricing, it's a topic in topic 3 that we like to test. So make sure that you are comfortable with it. And if you are unsure of anything, please do book a consultation with myself or with any of the lecturers. Let me see what else I wanted to speak about on the slides. Okay, so I had some slides on 24I10 Cap A because there's a amendment there. There's also some exam tips that I had included. But since we are way over the time, I think we can stop here for today. I will share these slides where you can go through the exam tips on your own. So yeah, I think that's that from my side. I'll pause here or stop here for today. So thank you so much for joining us today. and for staying until this time. I have the evaluation form here on the slide as well. So if you can kindly take a minute or two to complete the form, we'd really appreciate your feedback. And just wanted to remind you that next week, Tuesday, we have another exam technique session, which is aimed for tx42 students. However, as always, level 2 should join or is more than welcome to join the session. And again, on Wednesday as well, we have another session for both level 1 and level 2. Okay, so that's it from my side. I'm just gonna look at some of the questions in the chat. But I think that's where we can leave it for today. Saj, I think you can pause or stop the recording.
Okay, stopping the recording now.
Okay. Thank you so much, ladies and gentlemen. If you have any further questions, please continue to